which in the case of commodities is shortages leading to much higher prices because of either industrial demand or monetary demand. Uranium and copper, it's industrial demand. They are needed for next generation power plants and power transmission. Silver is needed basically everywhere, but also as a monetary metal. It's the kind of thing that if gold gets too expensive, which for a lot of people, it is in a visual sense, like you put a grand in the palm of your hand and it just looks like this small gold coin, it's like the size of an old silver or $50. But it's worth $4,000 now, and then you think, all right, what does $4,000 worth of silver look like? And it's a nice big pile of beautiful metal sitting on your table, So at this point in precious metals bull markets, people normally start doing that kind of a calculation. All right, gold's going to go up, but boy, is it expensive. Look how much silver I can get for the price of one gold ounce. And then people start buying silver. A big part of it is the dollar devaluation play. People have just concluded that we have no choice but to inflate the dollar away, and the euro and the yen and the pound sterling and the yuan. All the big currencies have to be inflated away to cover all the debt that we've taken on. And people have kind of known that in theory for a long time, but now it's becoming more real. And you're seeing the central banks of the world just snarf up all the gold they can get a hold of. And people are taking their cue from those central banks. So there's a lot of gold buying across the board now. And then with silver, silver always had two really good stories. It was a monetary metal attached to gold in a lot of ways, and an industrial metal that we actually really need, and that if it was just an industrial metal, we would still be running a silver deficit that'll turn into a shortage that'll blow the price way up. So I think people are recognizing that too, including the U.S. government that just named silver a critical mineral,
right,
or critical metal, and meaning that the U.S. economy does not function without the metals on that list, and silver is one of them. So now there's going to be a lot of stockpiling, where if you make, say, missiles, for instance, or solar panels or whatever, you've got to have a certain amount of silver available in order to meet the orders that are coming in. And you can't just wait until the day before you need it and buy it on the spot market anymore, because spot markets are unreliable, especially for crucial things like silver now is. And so what you're going to do is stockpile. You're going to buy ahead of time. And I think that's a lot of the demand for silver too, is people who might not be using it right away, but they want it to be there when they need it. You put those two things together, and gold is not that huge of a market, but it's much bigger than silver. So with central banks buying gold, that's a wind at gold's back for as far as the eye can see. And with silver, the fact that it's just a tiny little market, it's thinly traded. There's just not that much silver out there. And we're using up above ground stocks at an accelerating rate. So I think there's a real possibility of a silver squeeze here that people have been talking about for a while. And I think, there's a decent chance that that's something that happens in some form in the next few years, where the metals exchanges just, start intimating that they don't have enough silver, and then somebody proves it by defaulting and paying out in cash on futures contracts instead of physical silver. And then boom, that's it. Then you get your triple digit silver with a bullet. There's no real upside limit to a tiny, thinly traded market that is suddenly in default. So I think $100 silver is a very reasonable target over the next couple of years, and it's possible that it really overshoots. So I think 100 is where you start taking serious profits, but don't sell everything, because there's the potential for the next parabolic run, and that could come sooner rather than later if silver breaks into 100.
Central banks, often the most conservative financial actors, are now aggressively expanding their gold reserves. This trend reflects a deeper strategic pivot. Nations want assets that withstand inflation, sanctions, and geopolitical instability. As institutions lead the charge, Retail investors are following closely behind. Gold's appeal is straightforward. It requires no counterparty, no credit system, no political promise. In an era defined by debt and uncertainty, governments from Asia to the Middle East are buying gold at record levels. The metal's renewed importance signals more than fear. It marks a restructuring of global monetary foundations already underway.
You can't predict stuff like timing, and I would go out on a limb and say absolutely nobody actually knows what's going to happen in the next 6 months. Although a lot of
Right.
people make careers out of those kinds of predictions, but there are very few billionaire short-term traders out there because it's just very hard to do. What you want to do with any kind of investment, but with commodities in general and gold and silver specifically, is you just want to be in the on the train that's leaving the station. You don't know when it's going to leave, but you know what direction it's going to go eventually, and you just want to be there. You want to be on the right side of history, which in the case of commodities is shortages leading to much higher prices because of either industrial demand or monetary demand. Uranium and copper, it's industrial demand. They are needed for next generation power plants and power transmission. Silver is needed basically everywhere, but also as a monetary metal. It's the kind of thing that if gold gets too expensive, which for a lot of people it is in a visual sense, like you put a grand in the palm of your hand and it just looks like this small gold coin. It's like the size of an old silver or $50, but it's worth $4,000 now. And then you think, all right, what does $4,000 worth of silver look like? And it's a nice big pile of beautiful metal sitting on your table. So at this point in precious metals bull markets, people normally start doing that kind of a calculation. All right, gold's going to go up, but boy, is it expensive. Look how much silver I can get for the price of one gold ounce. And then people start buying silver. And then you get the parabolic move up because, like I said, it's a very thinly traded market. You get just a little bit of extra generalist money coming into this sector, or at least a little bit by comparison with generalist money. And it'll push silver way up. And I think that's the kind of thing that we will see pretty soon. It might be 5 years or it might be next week. That's the thing. So you want to be positioned now because you're hearing all this stuff, right, about different commodities exchanges where the amount of silver they've got on hand is falling precipitously, and it's not clear how much more is going to be left because more and more futures contract players are standing for delivery. And all you need is one contract on the COMEX to be settled in cash instead of metal, and boom, silver becomes unobtainium, and it goes straight up. So without being able to predict the timing, you can kind of predict the event, and you just want to be there when it happens. So, there's no real choice but to get yourself positioned and then just suffer whatever you have to suffer until it happens. And, you're in better shape than a lot of the stackers that started stacking in 1999. Or I'm sorry, 20. Yeah. Was it 1990? Yes, it was 1999. Before the beginning of this century, when gold was $240 an ounce and silver was like $4 an ounce. Okay.
Oh man,
lots of people started stacking then, and it wasn't all that long ago. I mean, it's in this century. It's just
it's not that long.
25 years ago.
Yeah. If you're stacking for 25 years at $4 silver, or you started then, man, you're laughing right now.
Oh my God! Yeah, there's a lot of increasingly rich stackers out there who had to wait a long time. I mean, it's been 10 years, or it was 10 years of doldrums for silver from 2015, or let's say from 2012 to 2022, give or take. And then finally, gold and silver started moving. But for that whole decade or so, that was a boring place to be. And it had a massive opportunity cost because all kinds of tech stocks were just going through the roof, and Bitcoin was going up by hundreds of thousands of percent. And, you were stacking silver, you missed all that. But you're glad you did if you stuck with it, because now you're in one of the best performing assets in the world, with a lot of good performance ahead of it. It's relatively safe. And the real shortage dynamic hasn't kicked in yet. So that's still to come.
Silver occupies a rare position in global markets. It is both a monetary metal and an industrial essential. Even without investment demand, the world would face consistent supply deficits due to soaring usage in electronics, solar technology, medical equipment, and defense systems. Recognizing its strategic value, the U.S. has recently designated silver as a critical mineral, meaning industry cannot function without reliable access. Companies involved in renewable energy, semiconductor manufacturing, and military production are now stockpiling silver proactively. As just-in-time inventory becomes risky, long-term strategic storage is surging, adding persistent pressure to an already tight market.
Well, we are in the everything bubble, which means there's a whole bunch of stuff that can blow up on us now. Commercial real estate is a nightmare waiting to happen, and local and regional banks are stuck with a lot of that bad paper. And, cryptos, wherever Bitcoin ends up, and it may be successful and it may be the next generation money, but or it may not be, I don't know. But you can say with certainty that a lot of the shit coins are going to zero. So that's a potential bubble bursting there. And obviously AI stocks are a massive bubble. And, AI, as the internet did in the 2000s after the dot-com bust, the internet went on to change the world. And so you can have a bust in the AI stocks, and AI can still change the world going forward. It's just that their stocks got way overvalued.
Right.
And I think with a lot of the games they're playing in that market, the vendor financing where NVIDIA gives OpenAI $100 billion, and OpenAI promises to build out a bunch of data centers with NVIDIA chips, so that money comes back to NVIDIA. And that's happening with a bunch of these companies. And that's the kind of thing that's very dangerous, because one player in the big circle jerk they've got going on there, who defaults, who doesn't make it, and fails for whatever reason, that can pull the rest of them down, because it instantly taints all the other guys who have been doing this vendor financing. So you can see NVIDIA going down by half and still be a richly valued stock. It could still have a triple-digit PE ratio. So that's, and let's say that happens. Let's say that the AI stocks have a major correction. That knocks the NASDAQ down, which in turn pulls down the rest of the complex of U.S. stocks, which, since, the economy is based on AI stocks right now, and then on the NASDAQ and everything. So the U.S. economy tips into recession. That pulls the globe into a recession. And then you've got something like 2008, 2009 again, where multiple sectors are blowing up, and the governments of the world are trying to figure out who to bail out to keep us from tipping into a 1930s style deflationary depression. And they'll choose caution, which is to say they'll bail out everybody. and then we're back in a Weimar Germany kind of hyperinflation scenario. So yeah, that's right out there in front of us. Maybe that could be next year when that happens. You saw what Michael Burry did. Right?
Yeah, I did see that. Why did he shut down his fund?
Because it didn't work out right away. He bought put options on NVIDIA and Palantir, which are two very big AI stocks. And with options, you basically have to be right in a limited amount of time. Like if you buy long dated put options, you've got a couple of years in which to be right. But you see that time value eroding right before your eyes. And if you do it with $1 billion like Michael Burry did, then he was probably under an awful lot of pressure from his investors. I don't think he just used his own money. He was using his hedge fund, which he just closed down and returned the money to everybody. So he put that short on, and it didn't work because it got so much publicity, I think. He put it on and we didn't know about it. But then when he had to report it, everybody picked up on it and it became headline news, and he bailed. But that was a logical bet. Betting against that kind of a bubble historically has had a big payoff for the people who timed it right, and it destroyed everybody who didn't time it right. So 90% of the people who short bubbles lose everything, because you cannot time the bursting of a bubble. But the guys who come in late enough and stick with the early disappointment end up making big short kinds of money. There are household names in the finance world who shorted the housing market in 2007, and they stuck with it until it blew up in 2008. And then they were made famous by the book and the movie, The Big Short. So the same thing's going to happen again here, but we don't know whether it happens this year or 5 years from now. I'm comfortable saying it could be this year, but then I'm not way short the AI stocks. I have some NASDAQ shorts, which is close enough to being short the AI stocks for my taste. And I would seriously consider adding a lot of NASDAQ shorts over time if that market holds up for a while. So we'll see.
Mm-hmm. Did Burry close his shorts position against the
Yes.
AI? Really?
He just did. He just closed down and unregistered his hedge fund.
Why did he unregister it?
Because he closed the hedge fund. He just shut it down. And then when you do that by removing the registration somehow.
Right.
And he sent the money back to everybody. And so he just stepped back out of that thing in a hurry. So
silver's market is tiny relative to gold, making it highly sensitive to shifts in demand. With above-ground supplies shrinking and more futures traders demanding physical delivery, pressure on major exchanges continues to build. A single forced cash settlement instead of physical metal could trigger a global scramble, driving prices sharply higher and potentially pushing silver into triple-digit territory. Analysts warn that once confidence in paper silver breaks, real metal could become extraordinarily difficult to obtain. In this environment, even modest new investment inflows can produce outsized moves, creating conditions for a dramatic, possibly historic, price spike.
If you're a really high-profile short, you make yourself a target because somebody else with money can come in and buy the asset you're shorting, push it up, and then break you. Right. So, Michael Burry, he bet $1 billion, but there are trillions of dollars at stake in the AI market right now. So what's stopping NVIDIA from stepping in with, $10 billion or something like that and just buying its own stock back and buying Palantir stock or something? So
they'd wipe him out.
They could certainly cause him a lot of pain.
Yeah.
And maybe he just wanted to get out before that happened because he realized he was a target. I don't know. And he also was probably getting a lot of phone calls from his investors saying, okay, you just bet my life savings on 2-year duration options on the stocks that have gone up more than anything else in human history. That'd be a painful phone call to take if you're a hedge fund manager.
Predicting timing in commodities is nearly impossible. But direction becomes clear when structural shortages collide with rising monetary demand. Silver, copper, uranium, and gold all fit this pattern. As prices climb, many investors compare gold's cost to the large quantity of silver they can obtain for the same amount, accelerating a rotation into silver. Historically, major silver rallies occur when generalist investors enter the market, overwhelming its limited liquidity. With global inventories declining and delivery requests rising, the setup for a breakout is forming. But patience is essential. Long-term positioning, not short-term prediction, remains the winning strategy.
Well, yeah, see, this story might have a lot more to, because today tech stocks got whacked, right? So Burry would have made money, presumably, in this week. So he would have been up. And he got out. So, the end of this story could be missed opportunity where everybody's going, oh, my God, do you realize how much Michael Burry would have made if he'd just stuck with it for another 6 months? Jeez. So, when you're a really high profile, aggressive speculator like that, that's one of the risks you take is that you become water conversation in the financial world because everybody knows what you're doing. And if you do it wrong, everybody knows that. And so if you're right, you're a hero. If you're wrong, you're a cautionary tale. And nobody wants to be a cautionary tale. The definition of a bubble, one of the definitions of a bubble is a market where a ton of big money is betting on whatever the thing is going up, right? Because that's how you get bubble prices, is you got tons of money flowing in. So yes, there are a lot of people who would really not like to see Michael Burry succeed in shorting the stocks that they're long. So yeah,
crazy.
That's going to be kind of a footnote, however it plays out. in the AI bubble story.
Yeah.
Hopefully it's, yeah, I like Michael Burry from the way he seemed in the movie and everything.
Oh
So
yeah.
I don't want him to become um, a cautionary tale. So hopefully it works out for him somehow.
We are living in what many analysts call the everything bubble. Commercial real estate is weakening, speculative cryptocurrencies continue collapsing, and AI stocks trade at extreme valuations. Behind the scenes, vendor financing loops, where companies fund customers who purchase their products, are introducing hidden systemic risks. A single failure in this chain could send shockwaves across the tech sector, triggering a broader market correction. Hedge funds attempting to short these inflated valuations face enormous pressure as high-profile bets become vulnerable to counterattacks from deep-pocketed players. In a fragile market built on confidence, one crack can quickly become a cascade.